The Elliott wave has received considerable discussion through the years, with many derogatory comments from those who don't make money using it simply because they don't understand what it is and how it works. The Elliott wave is the underlying structure of the market. This presentation will teach you the basic principles of counting Elliott waves the Profittunity way. I have been trading, teaching, and coaching the Profittunity Trading Group methods for over 18 years. After working personally with over 3,000 traders, in my opinion, their biggest problem is that they do not have a good map for understanding the underlying structure of the market. Even with a good trading system, they can still fail because they do not know what direction to expect next and why. I have compiled all of my knowledge and experience in counting waves for you in this presentation with the hopes of giving traders a good map that they can really read and use to improve their trading results. It has been created with the goal of helping all traders become profitable in the markets. The Elliott wave is not a standalone method to trade the markets. It does not give exact entries or exits. It has been studied for over 90 years, and yet it is one of the most difficult areas for traders to understand or analyze correctly. There are dozens of newsletters and software programs predicting the markets, but in my experience, most of these writers and programmers don't even trade their own recommendations. If waves are analyzed correctly, it's a great way to get an understanding of what type of behavior or direction to expect next in the markets. This advantage can help you know when to trade aggressively with your signals. It can also help you know when to simply stay out of the market and get ready for the next trend move. Elliott wave theory. Up in the right-hand corner, we have a picture of Mr. R.N. Elliott back in the 30s. And the intent of this presentation: to establish an understanding of the basic principles of the Elliott wave theory created by Ralph N. Elliott, and to take the ambiguity out of counting the waves. The primary reason to be interested in understanding the Elliott wave is that it is the best indicator of where you are in the market's movement from up to down and back again. And to see how the Elliott wave is the underlying structure of all markets, and it's like having a map of the markets. And finally, to help refine and improve your trading results. You will still need a trading system for exact entries and exits into the market, but you will now have an understanding of what the underlying structure of the markets is by the time we finish this presentation. The underlying structure of the markets. All markets have an underlying structure made up of sequences of waves. R.N. Elliott was the mastermind behind discovering these repeating patterns in the markets in the 1930s. Since then, many have tried to recreate the wheel or even think they have discovered a new wave theory. The basic rules of wave theory are simple enough. However, the application of these rules daunt most theory students and traders, and have for over 75 years. Using our approach and additional indicators can make this job simple, concise, and much more accurate. We have used this method for over 20 years successfully in our personal trading accounts and coaching and teaching others. The basic principles of the Elliott wave are still followed with this approach. However, we have added some visual aids and indicators to help ensure correct analysis based on the Profittunity method. We're going to be looking at pattern recognition throughout this presentation. That's how we're going to be seeing the Elliott wave patterns. We're also going to be talking about the actual waves themselves throughout the course. Okay, here's a typical 5-wave pattern and a 3-wave correction. We're just going to do a little overview here. Basically, by the time we finish this presentation or course, you should be able to look at this diagram and it won't seem confusing to you. So if it's a little confusing right now, don't worry. Basically, what we're looking at here, this thicker line, this line here that we're pointing at, the 1, 2, 3, 4, 5, there are larger degree waves, and the A, B, C. And then inside of that are these smaller lines where you have the 1, 2, 3, 4, 5. And this is the 5 waves inside the first wave of the impulse wave. And then you have an A, B, C inside the second wave correction. 1, 2, 3, 4, 5 in the third wave. A, B, C, D, possibly E in 4. And 1, 2, 3, 4, 5 in the fifth wave, followed by your A, B, C correction again. Hopefully you'll see these are just repeating patterns that are going to go in different directions into the market. Tides, waves, and ripples. On a beach, you will find several different interacting forces and momentums. The tide slowly comes in and out at least one time a day. So if we're looking at a chart, that might be looking at a monthly, a weekly, or a daily. On a shorter time frame, you notice waves that are coming in and out much faster and covering much less ground than the tide. That might be a daily, a 60, or a 30-minute chart. And on an even smaller time frame, you'll notice ripples that play back and forth on the larger waves, being maybe a 10 or 15 5-minute chart. So the markets, being a natural phenomena, work exactly the same way. You can never put your foot back in the same place in the water just as you changed it by putting your foot in or walking in the sand. The markets are very much like that. The Elliott wave is a great guide, but no wave or no chart will have exactly the same pattern. It is always changing as it unfolds to create the next set of waves. If anyone truly figured out the markets with a success rate of 100%, there would not be any markets left to trade. The market's job is to find an equal balance of buying and selling pressure. And markets are chaotic in nature and unpredictable, yet create self-similar repeating patterns. Pattern recognition in fractals. Elliott's market model relies heavily on looking at price charts. Practitioners study developing trends to distinguish the waves and wave structures and discern what prices may do next. Thus, the application of the wave principle is a form of pattern recognition. The structures Elliott described also meet the common definition of a fractal, which is a self-similar repeating patterns appear at every degree of a trend. Elliott wave practitioners say that just as naturally occurring fractals often expand and grow more complex over time, the model shows that collective human psychology develops in natural patterns via buying and selling decisions reflected in the market prices. It's as though we are somehow programmed by mathematics, seashell, galaxy, snowflake, or human. We're all bound by the same order. It was from Elliott. Benoit Mandelbrot was a maverick mathematician who developed the field of fractal geometry and applied it to physics, biology, finance, and many other fields. He coined the term fractal to refer to a new class of mathematical shapes whose uneven contours could mimic the irregularities found in nature. Using fractal geometry, he argued the complex outlines of clouds and coastlines, once considered immeasurable, could be using his fractal dimensional approach. The Rosetta Stone of fractal geometry is the Mandelbrot set shown in this picture. The Mandelbrot set, the master fractal and building block of fractal geometry, is produced by graphing the numbers resulting from the iteration of a second-degree polynomial on the complex plane. And don't be concerned, you don't need to understand all these terms in order to count Elliott waves. I just want to give you a little background of some of the information we're going to be sharing with you during this course. Fibonacci number sequence. Fractals are produced on computer screens by using a process called iterations. The simplest model of iteration is the Fibonacci numbers. The sequence starts with 0, and the two terms are added are 1 and 1. Add 1 in the starting 0, and the answer is 1. Add the second 1, and the answer is 2. From that point, the immediately preceding two numbers are added together to get the next number sequence to get 3. You'll add 3 plus 2, and the answer is 5. You'll add 5 plus 3, and the answer is 8, and so on. The sequence continues to infinity. It's also known as the golden ratio. The Mandelbrot set is structured in Fibonacci 0.618 relationships and is composed almost exclusively of spirals and helixes. Mandelbrot's fractal theory. Clouds are not spheres, mountains are not cones, coastlines are not circles, and bark is not smooth, nor does lightning travel in a straight line. This is a quote from Benoit Mandelbrot. If you take the nautilus shell, stand it on end, and butterfly it as you would a steak, you will get a figure very similar to the Mandelbrot set. Mandelbrot emphasized the use of fractals as realistic and useful models of many rough phenomena in the real world. Natural fractals include the shapes of mountains, coastlines, river basins, structure of plants, blood vessels, and lungs, the clustering of galaxies, and Brownian motion. Fractals are found in human pursuits such as music, painting, architecture, and stock market prices. He also believed that fractals, far from being unnatural, were in many ways more intuitive and natural than the artificially smooth objects of traditional Euclidean geometry. The fractal actually means a fractional dimension. The fractal is also a measure of irregularity. The more irregular and choppy the market is, the larger will be its fractal number. The fractal number of a portion of a move will always peak at a turnaround point. Therefore, all markets' trend changes are accompanied by a higher fractal number than the bars leading up to the change in trend. In our own original research, the PTG group, Profitability Trading Group, has discovered several repeating patterns that allow a degree of predictability about future market movements that are quantum leaps ahead of the accepted current technical analysis. Let's look at our definition for a fractal on a chart. A fractal is a change in behavior with a similar repeating pattern. Fractal by, a sequence of 5 or more bars where the center bar or group of bars are preceded and followed by 2 lower highs. A fractal cell, a sequence of 5 or more bars where a center bar or group of bars are preceded and followed by 2 higher lows. So if you were to take your hand and put it in front of you and look at the middle finger, that middle finger would be the high of a fractal point, with being the 2 fingers on either side having a lower high. If you flipped your hand upside down, pointed it towards the ground, that middle finger would still be the fractal cell. Okay, so that's going to give you a visual of what a fractal looks like. It takes at least 5 bars to create a fractal signal, can be more, and between every fractal is a degree of Elliott wave. Here are some other formations we're going to take a look at. So here we have a pristine fractal by. This would be like if you're looking at your hand in front of you, that would be your middle finger, your 2 fingers to either side. So that would be your fractal by. On B, we have a fractal by and cell where they actually share a middle bar. They have 2 lower on either side on both. C, here's a fractal cell, pristine. D and E, you'll see a fractal by and cell, and E. So here's some different formations. Now, important in E that equal highs do not count. So 1, 2, you have 2 lower highs to the right of this point, so that creates the fractal, the completion of this bar. Fractals on the chart. When we're looking at a chart, they're going to be marked, and what you're going to see here, the green caret's going to be a fractal by, fractal cell. Now that really doesn't matter. We're not going to be implementing those in this presentation, but we want you to understand that between every fractal is a degree of Elliott wave. Let's talk about the awesome oscillator. We call it the AO. The AO is a 34-bar simple moving average of the bar's midpoint subtracted from a 5-bar simple moving average, then plotted as a histogram on the chart. The AO measures the market's momentum. When new orders or volume come into the market, the momentum will usually change before the price. Now with heavy movement, you will see the momentum or the AO change with the price, but typically it will change a bit ahead, 2 to 3 bars. The Profitability AO is a very accurate indicator for counting the Elliott wave. To get the most accurate measurement, the wave under consideration should occupy 100 to 140 bars. Now this doesn't mean you can only read Elliott wave with 100 to 140 bars. This simply means when we're breaking down a wave or seeing if a wave is complete, there must be that number of bars within the wave under consideration. Profitability oscillator taking the ambiguity out of Elliott wave. One of the key indicators in counting the Elliott wave is the awesome oscillator. It's the 534 simple moving average of the bar's midpoints, 34-bar moving average, and subtracted from a 5-bar moving average. It produces an oscillator programmable on most software packages. If you're one of our clients, you already have it, or you may have gotten the oscillator with this course. The AO histogram is painted green if higher than the previous bar, and the AO histogram will be painted red if it's lower than the previous bar. That will also be reflected on the price chart. So you'll see green if the AO is green, and red price bar if the AO is red, unless it's a squat bar, which we'll be covering, and that will be painted blue. 3 primary uses for the awesome oscillator: to identify the peak of wave 3 on any time frame of some degree, to determine if the minimum requirements for wave 4 have been met, to find divergence between price and momentum, and to signal where the current momentum of the market is. Identifying the peak of wave 3 with the AO. Wave 3 will be the tallest peak on the AO within the 100 to 140 bars. There will be divergence between the AO and price during wave 3. Okay, the awesome oscillator AO peak. Let's go ahead and take a look at what we were talking about here on an actual chart. On this chart, starting from here to here, we have the correct number of bars, a little over 100 bars here, and we're looking for the tallest peak on the AO. Here is our tallest peak, and we follow this up. We know this is our wave 3 of some degree. Now here's a wave 4 and continues wave 5, and we'll get into this later. Of course, you may not understand that yet. But what we're trying to look at here is our tallest peak is wave 3 of some degree. So it's always used to identify where we are. Once you identify wave 3, you can look forward and backwards to see where you are in the count. As we mentioned, if this is wave 3, what follows 3 is wave 4. And to get the correct number of bars, you simply change time frames until you can have the 100 to 140 bars for the wave under consideration, and we will discuss this more throughout the presentation. Here's a wave 3 peak on the AO. So the tallest peak on the AO within the 100 to 140 bars will be wave 3 of some degree. So we're looking here, we've got a wave 3, tallest peak, follow that up. And there are 110 bars from where it began to where we were currently. Divergence on the chart. We have found that divergence can be an advanced indicator for the end of a trend and an impulse series of waves. It also helps to forecast the change of trend. Wave 1 will have the tallest peak in a new wave sequence, and as the wave unfolds, wave 3 will take out the previous wave 1 peak. Wave 5 should not be taller than wave 3. So what happens is when a wave is developing, wave 1 is going to look like wave 3 because we have no wave 3 yet. It is our tallest peak. As wave 3 develops, it takes out wave 1. We now know we're in wave 3. Now, let's get a little more detailed oriented here. When the proportion of bars 100 to 140 is correct, you will see a divergence that does not go back to the 0 line. What you're seeing is wave 3 peak inside a larger wave 3. The AO will retrace, but not to 0. Right here, we'll retrace. Then come back and generate a divergence. This is telling you that it's wave 5 of wave 3, and therefore the real peak of wave 3 is at the tallest point on AO in the wave under consideration. So what I'm saying is here is we have divergence within wave 3. So what we're going to learn is there are 5 waves within wave 3. So this is a 3, pulls back 4 and a 5. It's created a divergence between the AO and the price. So the price is lower at the taller peak, but higher at a lower peak. Now, between wave 3 and 5, we also have divergence. So this wave and this peak here is taller than this one. So from this point to this point, we have divergence as well. So that's what we're discussing, and this will become more clear as we go through the presentation. Minimum requirements for wave 4 on the AO. The AO must cross the 0 line in wave 4 with the correct number of bars. That's the 100 to 140, the wave under consideration. If you're looking at a wave sequence that's less than 100 bars wide, then you're going to be measuring an Elliott wave, but of a larger degree. And if your wave sequence occupies more than 140 bars, you're measuring an Elliott wave of a smaller degree. Example, if you're looking at a 30-minute chart and you want to determine the wave count in the wave sequence you're considering only has 60 bars, you simply go to a 15-minute bar chart, and then you have 120 bars to get the correct count. You may have to try a few different time frames to get the correct sequence here. This is not an exact science. What we're trying to get is anywhere from 100 to 140 to see if we have what we need to complete a wave. So after the end of wave 3, the AO oscillator will pull back with the retracing of wave 4, which we see here. The histogram will fall below the signal line, telling you that this is not a good place to initiate a trade against the trend. However, there's one very important consideration we must address here. The 534 oscillator is a very accurate indicator for the Elliott wave, providing you understand how it works. So understand we are always measuring an Elliott wave, but of what degree? So that's why after 25 years of research, we found that if a wave has 100 to 140 bars, we will see if it has the components it needs to be complete. What is a squat bar? A squat bar is the last battle of the bulls and bears with lots of buying and selling but little price movement. We labeled this bar a squat bar because it has the market squatting, getting ready to leap one way or the other. 80 to 85% of the time, a trend will end with a squat bar as one of the top or bottom 3 bars. If it's not a trend-ending squat, it tends to become a measuring squat, similar to a measuring gap, predicting how far the current move will go. Squats are characterized by greater tick volume and smaller range when compared to the previous bar only. Range divided by volume and the answer compared to the previous bar is how you get this. Now on the charts, you're going to be seeing squat bars are going to be painted blue, and we'll overlay the color of the green or red from the AO. Okay, let's take a look at squat bars on the chart. First thing to notice here is the circle is going to be trend-ending squat, and this more oblong shape is going to represent a measuring squat. So we're looking here, actually there would be a trend ending there, not circled. Here we have a measuring squat. Here we have a circling squat. So as we talked about in the last slide, top 3 or bottom 3 bars is typically where you're going to see these. So I'm going to point out with the cursors, this is a top 3, bottom 3, bottom 3, top 3. So it's next to the top bar. It's not the top bar, but next to. These are measuring squats. Here's bottom, trend ending next to the top 3 where the change in trend took place, measuring, trend ending, trend ending, trend ending, trend ending. We have a measuring and a trend, and these are trend endings. So you can see 80 to 85% of the time you do have a squat bar. It is present before the directional move. Even if it's just 1 or 2 bars before it moves, squat bars are present quite a bit of the time. Now let's look at this chart a little better. We have again, here I showed you which is squats are trend ending and which are measuring. So we have quite a few of trend ending here along the way, as you'll see. And then here in this circled area, let's talk about that. If we're going to try to figure out how to measure the measuring squat and to get a distance target zone for the immediate trend, what we're going to do is we're going to start from the beginning of the move, the bottom of this bar. And bottom of this bar here where my arrow is pointed at. And we're going to measure from the bottom of that bar to the middle of the next squat. Now as we see, the next one came out. So if we started our measurement from the low of this bar to the middle point of the squat bar, take that distance and add it to, it gives us a target zone. In this particular case, 2 bars later, another squat bar came out. So we measured from the beginning of the move to the middle of that squat bar, and what we had, 2493, was the low of that bar. The middle of that squat bar was at 2631. The high of that move is 2796, which was also a trend ending squat there. If you take the difference between the 2631 and 24, you get $1.38. The target zone would have been from the middle of this bar, 2631, adding the $1.38. Our target area was 2769. The actual high hit 2796. So we're within almost 20 cents. So you can see that a measuring squat, much like a measuring gap, can give you an idea of how far the move can go. Visually, it's very easy to see. If you were to look from here to the top of this move and you went from the bottom to the middle of this and added that again, you come into here, you get more measuring squats added again. So the measuring squat is not an exact science, but we have found that they can be very helpful, especially in a trend. And of course, the trend ending squat bars are very useful. When you add that with the Elliott wave and our other indicators together, it gives us a good idea of what's happening and what could be coming ahead. Now let's do a review of all the material we've covered so far in this part of the presentation. There's a lot of information here. We want to make sure you understand it. If you don't, we're going to go back and do some review. The Elliott wave is the underlying structure of the markets. The fractal is the underlying structure of the Elliott wave, and fractals are self-similar repeating patterns repeating at every degree of a trend and within the trend as well. Typically, there's a 5-wave pattern followed by a 3-wave correction. Now, this 5-wave pattern can be 5 waves up with a 3-wave correction down, can be 5 waves down with a 3-wave correction up, and they're going to alternate between every degree once we've finished a complete 5-wave move. The waves, tides, and ripples of the ocean are similar to the Elliott waves of the market, represented on different time frames. And we discussed this. So if we're looking at the waves, tides, and ripples, we're looking at the different sides of the market. So we could be looking at a monthly, a weekly, or a daily, or possibly even an intraday chart. So if you want to visualize that in the market, let's say you have a position that you're long in a daily chart, and I come in on a 30-minute chart and I go short and make money. I'm actually playing off the ripples, and you at the end of the day also make money being long on a position. So that's what happens inside of waves. It's going to kind of bounce back and forth within that time frame. The AO is a 534 simple moving average plotted as a histogram. The tallest peak will be wave 3 of some degree with the correct number of bars, and that's that 1 to 140. There will be a divergence on the AO in wave 3 and between waves 3 and 5. So remember, in wave 3, if you don't have the correct number of bars, you're going to have a divergence within wave 3. Wave 3 of 3 is going to be a peak. It's going to pull back for wave 4 of 3, probably will not cross 0 without the correct number of bars, go back up for 5 of 3, create a divergence there, and then it will cross the 0 line for the big wave 4, and then the next wave 5 will create another peak, but it will not be as tall as the peak on wave 3. So you can have divergence within wave 3, you don't have to, but you must have divergence between wave 3 and wave 5 to have a complete wave. Wave 4 will always cross the zero line with the correct number of bars in the wave under consideration. And 80 to 85% of all moves end with a squat bar in the bottom or top 3 bars. Remember, if it does not end the trend, then it's a measuring squat, which those are very similar to the measuring gaps. So putting all this together is going to really help us when we get into the next part of this section. Is going to be on counting the waves itself. These visual indicators or prompts are going to be part of the difference of making us successful and not successful in the markets. Now it's time for a break before we get started on the Elliott wave. Basic rhythms of the Elliott wave. The Elliott wave sequence consists of a basic rhythm of 5s corrected by 3s. This remains constant no matter what degree of Elliott wave you're analyzing. This wave rhythm remains constant so long as there is a minimum amount of trading volume. As a rule of thumb, we use 20 ticks per time period, although Elliott wave sequences can be seen in shorter time periods markets with much less volume, e.g. a 1-minute chart. Basic rhythms continued. Impulse waves are considered to be waves 1, 3, and 5. They all have 5 internal waves. Within these waves are smaller degree corrections, wave 2 and wave 4. Larger degree wave 2 and 4 have internal waves labeled A, B, C, and D and E for irregular and complex corrections. Typically, they're mostly A, B, Cs. Even more important than the time scale is the form of the patterns. Waves can be stretched or compressed, both in time and price, but the underlying form remains constant. The movement will unfold in its primary direction in a series of 5 waves which are labeled 1 through 5. The 5-wave movement is normally corrected by a 3-wave movement in the opposite direction. Waves 1, 3, and 5 are called impulse waves, or trends. Waves 2 and 4 are corrective waves labeled as A, B, and C, and again D and E for irregular or complex waves. Now here's an Elliott wave impulse pattern. The major trend in every time frame takes the form of 5 waves, impulse wave, which, once completed, are corrected by 3 waves, corrective waves. This is a bull market description where wave 1 is the up and wave 2 is down, correcting wave 1. When wave 2 is finished, wave 3 again moves upward, followed by a downward wave 4 that corrects wave 3. The final leg is labeled wave 5, ending the entire swing, or this particular move. The corrective wave 2 and wave 4 normally retrace wave 1 and wave 3 by a Fibonacci relationship. Typically, wave 2 is going to retrace very fast in price and time, and wave 4s are going to take longer in time but not as far in price. Now here's a diagram of a wave 1. Don't get too worried if this doesn't make sense. We just kind of going to give you an overview. We're going to actually show you on charts what we're looking at. So first to know that the thicker line here is our trend line, our large degree wave, and then the thinner line here inside are the 5 waves inside the move. So what we're looking at here, if this is a wave 1, it's going to go this way. We're going to be looking at the top for squats and fractals. So this is just the diagram. Personality of wave 1. First waves are always a change in trend movement. The first traders getting into this new trend are always running the have fun in the markets attitude. The beginning of wave 1, which is also the end of wave 5 that has come from the opposite direction, will be accompanied with a divergence on the AO. First waves are usually heavily corrected by wave 2. Once the wave is complete, we can expect a sharp move off the top or bottom of wave 2. This may also be a point 0 or most likely the end of a larger degree ABC correction, which you would just go to a larger time frame to confirm. Characteristics of wave 1. There will be 5 waves inside of wave 1. The previous wave should have been in a correction in the opposite direction or the end of a trend. Most, 85% of the time, a squat bar will be present in the top 3 or bottom 3 bars. You need 100 to 140 bars to count a wave, the wave under consideration. And the oscillator peak will be tallest at this point. It's going to look like a wave 3 because we don't have a wave 3 yet. Let's take a look at this on the chart. So we have wave 1. And we're looking at the oscillator, so at this point you can see that it looks tallest. But here we have a 1, a 2, a 3, a 4, and a 5 of wave 1. So this pullback here is going to be the 4 of the 3 of the first wave. So this is one wave here, second wave coming down. Now we have another wave 1. At this point we have wave 1, 2, 3, 4, 5 of wave 1. Now I'm just pointing at these, most of these are fractal points where I'm counting, because between each degree of a fractal is a degree of Elliott wave, or between each fractal is a degree of Elliott wave. So if you don't understand that yet, it's fine. We're going to be working on this the entire presentation. So 1, 2, 3, 4, 5 of wave 1. We have a peak here. We have divergence between here and here. And so on that chart, that's all we're concerned with right now, wave 1. Our next example here, we have a wave 1 coming up. Very strong wave 1. We have 1, 2, 3, 4, 5 waves. Our third peak is in here, so 3, 4, and 5 of wave 1. Tallest peak here, remember, because we don't have a wave 3 to compare it to yet, is going to be wave 1. And then we go into a complex correction here, which we will discuss in the correction area of this presentation. Now let's talk about wave 2. Here we have a point 0, or the bottom, let's say, of a C comes up, wave 1. Bottom of C here, wave 1 comes up. Our thicker line is our impulse wave. We know these smaller lines here are the internal waves within wave 1, the 5 waves. Wave 2 is an A, a B, and a C. Now, typically we'll see the wave 2 retrace about 62%. So about 73% of the time we see 50 to 62% retracement of wave 2 of wave 1. 100% of the time can occur. Typically we only see that in commodity markets. We don't normally see that in stocks or the ETFs. Let's talk about the personality of a wave 2. Wave 2 will be in the opposite direction of wave 1. Second waves are created by new selling and buying, as opposed to wave 4s, which are created by profit taking. The most common target for a wave 2 retracement is between 50 and 62% of retracement of wave 1, and almost 3 out of 4 wave 2s will end in this area. If wave 2 ends with less than 38% correction, wave 2 will almost always be in a regular correction. It's important to know when wave 2 happens, since our greatest profit-taking opportunity is wave 3. And the rule of alternation: if wave 2 is simple, then wave 4 will be complex. If wave 2 is complex, expect 4 to be simple. Don't worry if you don't understand this yet. We have a section on corrections, and we'll cover this then. Characteristics of wave 2. There should be 3 waves in wave 2, an A, a B, and a C wave. Most likely to retrace about 38 to 62% of wave 1. The wave 2 market should not go below the start of wave 1, and again, unless it's a commodity. There are exceptions. If wave A has 5 waves, expect a zigzag correction. If wave A is 3 waves and wave B is about the same length as wave A, expect a flat correction. Normally, quick and simple, fast and retraces in time and price. So that's usually how you can tell the difference between a wave 2 and a 4. Wave 2s happen very quickly, and they retrace very fast in price as well. And likely to have a squat bar in the top one or bottom top 3 bars, meaning that you're going to have a squat as a trend ending. Also, you're probably going to see a change in momentum, and you're also going to have a fractal. Okay, let's take a look at wave 2 on a chart here. We have a wave 1 that comes up, looks like our tallest peak, and the wave 2 retraces very quickly in time and price. So we have an A wave, a B wave, and then we have a 1, 2, 3, 4 of C, 5 of C. Again, we'll get into counting and breaking this down later. We just want to show you the overall visual pattern recognition that you're trying to see here. Typically, simple wave 2s retrace very quickly in time and price. This one retraces almost 100% of wave 1, but not quite. The beginning of wave 1 was down here, so we were within about 50 cents to $1 of that. So this retraced very quickly in time and price, simple wave 2. The next chart we have a wave 1 that comes up. I want to show you where the wave 1 is so we know where to start for wave 2. We have an A, a B, and a C wave. Simple zigzag ABC correction after an impulsive wave up. Another chart example here. We have our 5 of 1, so completion of wave 1. We have an A, a B, and a C wave here. So within this, if we broke this down to a smaller time frame, we would see what happens inside of it. But for now, we just want to know wave 1. We have a complex wave 2. It took a little more in time here if we look at this B wave. And then the C comes down, starting again of a 1, 2, and taking off into another wave that we're going to talk about next, of course, wave 3. So right now, we have a wave 1, a wave 2 coming back down, retracing below 0. Normally, we don't have divergence in it. It's not an absolute. Sometimes we will have divergence. Typically, the C wave will always take out the low of the A wave. Now finally, wave 3, what some people have called the wonder to behold. This is the wave, if you could load the wagon and know where wave 3 was, if we could just catch wave 3s to trade, that's the only wave we would need to trade. So if we're talking about here, bottom of C, we have a wave 1, wave 2. Here's our wave 3. Within wave 3, we have 1, 2, 3, 4, 5 waves. So the probability of where wave 5 goes, if you want to get into the mathematics and learn a little more about this, definitely take a look at our first book, Trading Chaos, the first edition. It will get into much more mathematical side of the waves. I am more teaching the visual side of counting the waves. Personality of wave 3. They're usually strong and long, and the trend at this point is unmistakable. Gaps, breakouts, or runaway markets occur most often in third waves. Generally, third waves generate the most volume and price movement and are most often the extended wave in a series. The best targets for the length of wave 3 is between 1 and 1.6 times the length of wave 1. Very rarely will wave 3 be less than wave 1, and most of the time it will be longer than 1.62 times the length of wave 1. During the third wave, the economic background supports the move, which is not true in wave 1. Characteristics of wave 3. Inside wave 3 are 5 smaller waves, and it's an impulse wave. Wave 3 cannot be the shortest wave among waves 1, 3, and 5. AO's tallest peak will be wave 3 of 3, and there should not be divergence between wave 1 and wave 3. The slope of price bars will be steeper than any of the other waves, and there should be a squat bar in the top bottom 3 bars. You'll also see a change in momentum and a fractal in the opposite direction. Wave 3 on a 60-minute chart. Now this may look a little confusing, but we're going to go ahead and move forward with it. We have a wave 1 of 1, wave 2, wave 3, wave 4, wave 5 of wave 1, an A, a B, and a C of wave 2. Now let's look at the AO and see why. Wave 1, we had a 4 here, cross within that wave 1 of those 5 waves. We have divergence within here as well, all within the wave 1. Now we have a wave 2, it crosses 0 line. Then wave 3 begins. We have a 1, 2, 3, 4, 5 of 3 at this point. Here's our tallest peak. We have a 4 here. It crossed the 0 line. We actually have the correct number of bars here to measure this particular wave. We're right at 140, I think. And so here we have 5 waves of 1. We have an ABC of wave 2. And we have 5 waves of the third wave here. Now, on this peak, remember, we have divergence between as well. So your price from here to here, and your peak from here to here. So it meets all the requirements. This is a 60-minute chart, allowing you to see what happens intraday. You can really see these waves unfold when you're looking at the smaller time frame. Another wave 3 chart. Now we have ending with a C of wave 2 here, so you have a starting point. 1 of 3, 2 of 3, 3 of 3, 4 of wave 3, and 5 of wave 3. We have divergence on the AO from the price here and to the AO's peak. So here is 5 waves within wave 3 because of the correct number of bars on the scale here. Another wave 3, again, correct number of bars in this move. We're just measuring to this point. Our tallest peak is this wave 3 on the AO. So we see wave 3 here, wave 4 pulls back, crosses, wave 5 of 3. This is 3 of 3, 4 of 3, 5 of 3. So we have the difference between these two and the divergence between here. Now we have a weekly chart with 130 bars. With the correct number of bars in this wave, we do not need to break it down to see the peak of wave 3 and the divergence. So again here we have a 1, 2, 3, our tallest peak. We always go here, 3, and I can go backwards or forwards. So if 3, wave 4, wave 5, A, B, C. I sometimes tell people if you can count to 5 and you know your ABCs, you can learn to count the Elliott wave. I did. Now let's take a look at this gold on a monthly chart. We're also going to discuss this later in more detail. But here, back in 84, we see this peak. We have a peak on the AO, and we thought that was wave 3, even though we find out after having over a 20-year correction or a wave 2, this would be what we call a complex wave 2. Now we see that our AO is at the tallest peak. We're in a third wave of some degree. So this third wave is not over. So we're just showing you here that this is an increasing building third wave, but you had a wave 1 here, a long wave 2. We have no divergence here because the peak of this wave 3 has taken out the previous peak. Obviously we can see from here to here that the price is at, was it the high there was of course at 1,400 something an ounce, and it is saying that it's not over yet. So when we're able to look at a larger term chart like this on a monthly, we can see the overall trend telling us that there's a lot more room here for this market to go. Okay, here's previous wave 4. What we're showing you here in this particular presentation is that the wave 4s typically retrace in the previous area of wave 4. So in this wave 3 here, in this impulsive wave, in the pullback of wave 4, most of the time, probably, I don't know, 50 to 60% of the time, maybe even more, you're going to see the wave 4 pull back into the same area of the previous of lesser degree wave 4. Let's talk about personalities of wave 4. Once the powerful wave 3 is over, profit taking enters the picture by most skillful traders. This is what creates wave 4. The character of wave 4 is completely different than the wave 2s, as they typically last much longer through time rather than price. 70% of time for wave 3 to complete. So if a wave 3 took a year, you could easily see a 6 or 7 month correction. It's quite possible. In our research, we have found that 85% of losses occur in wave 4. This is not the best time to trade aggressively in the markets. Behavior is unpredictable in corrections and make it hard to know where you are in the wave count. The C wave is an impulsive wave and can help identify the trend or the end of wave 4 for good trade location for wave 5. Now I'm just going to give you kind of a scenario on how I look at wave 4s. If I were driving, let's say we look outside and it's a beautiful day outside. The sun is shining, there's no clouds in the sky. I have a convertible, I put my top down, I go out, I run some errands and just enjoy the day. That would be like in a wave 1, 3, or 5, in an impulse wave. In wave 2s or 4s, that would be like, let's say we look outside, it's storming, it's raining. We know that there's a couple errands we'd like to do, but do we really need to do it? We know the roads are not as safe, driving conditions are different, we can't see as well, other drivers don't drive as well, our brakes don't react. To me, that's what a wave 4 is like. It's very unexpected behavior, kind of anything can happen. So if you don't need to get in your car and you have to run those errands, you'd kind of skip it. Same thing with a wave 4. If I don't have to trade a wave 4, I don't want to. What I do want to know about a wave 4 is if I can kind of see where the end is going to be near. As the C wave is an impulsive wave and many people do like to trade it, you also get great trade location for that wave 5. So characteristics of wave 4. Will not retrace more than 20% below the top of wave 1. Most of the time, again, except in commodities. It usually retraces between 38 and 50% of wave 3, and it does usually end in the area of the previous wave 4 of one smaller degree. If wave 2 was simple, wave 4 will be complex. That's that rule of alternation we discussed briefly. And if wave 2 is complex, wave 4 will be simple, again, the rule of alternation. And wave 4 can last up to 70% of the time it took for wave 3 to be completed. And again, should end with a squat bar in the top bottom 3 bars. You'll see a change in momentum typically, and you'll see that fractal. Okay, let's look at this wave 4 chart. Now here what we have, we're going to start up with a wave 1, wave 2, wave 3. That's our tallest peak, wave 4, and wave 5. Now remember, we discussed the correct number of bars. This has 120 bars in the move. So with that being said, we're going to see that wave 4 crosses 0 here within this move. We also have a peak of wave 3, and we have a lower peak for wave 5, so we have divergence between the third and the fifth wave of the third wave because of the number of bars in this sequence. So 1, 2, 3, 4, and 5 of the third wave. The other thing I want to mention here is to notice that all of these squat bars, trend ending, trend ending, trend ending, trend ending, trend ending. So you can see we have a lot of trend ending squats along the way, as well as we have the measuring squats. But in the wave 4, when we have the correct number of bars, you are going to see it cross the 0 line without divergence within the wave 3. If you don't have the correct number of bars, then the wave 4 may not cross the 0 line on the time frame that you are looking at. Next chart on wave 4. Here what we have is the markets coming down, creates that wave 3. Here's our peak. We have an A wave, 1, 2, 3, 4, 5 waves of A, 1, 2, 3 B, 1, 2, 3, 4, 5 waves of wave 4. Wave 4 crosses the zero line. There's no divergence between A and C. You'll also notice that this wave 4 was stopped or went retraced to the previous area of wave 4 in the wave 3. So you'll see that happen quite often. Next chart on wave 4. Here's our tallest peak, so we know that was 3. So we have an A, a B, and a C wave. 1, 2, 3, 4, 5 waves in A. 1, 2. This could be a 5-wave B. 1, 2, 3, 4, 5 waves of C. We have crossed the zero line here. We have no divergence, so we have a simple zigzag correction here following a wave 3. Okay, let's take a look at the fifth wave here on the chart on our diagram. We know that the thicker line here is going to be our trend line. Inside that, the smaller line is going to be our waves inside of the waves. So if this is the fifth wave, this is our probability here of where the waves can go, where the A wave can retrace back in the fifth. This is not to scale. Remember, if you want more detail on this, go to Trading Chaos First Edition. You will definitely get a little more math behind the measurement on the degree of waves. Personality of wave 5. Wave 5 is the last struggle of the traders to create a new high or low in prices. The slope of price line is less than the wave 3 and almost less dynamic than wave 3 unless it's an extended wave 5. The length of wave 5 is measured from the bottom of wave 4, so no final targets can be projected until wave 4 has ended. After a wave 5 is complete, look at a larger time frame to see what degree of wave you have just completed. And that's important. Looking at the larger time frame, you have 5 waves of what? Characteristics of wave 5. There should be no divergence between waves 3 and 5 on the AO. Wave 5 peak should be smaller with a higher price than the wave 3 peak. There are 5 waves inside of wave 5. Not as impulsive of a wave as wave 3 or as long as waves 1 and 3 typically. And almost always takes out the higher low of wave 3 in price, but not on the AO. Should end with a squat bar in the top or bottom 3 bars, as well as the change in momentum and a fractal. And the complete movement of waves 1 through 5 will usually complete the next tier, higher tier of wave sequences. So as I mentioned, look at that larger time frame and see what we have completed 5 waves of. Now let's say 5 waves on a monthly chart. We're going to find our tallest peak, wave 3. We go back, wave 1, wave 2, wave 3, wave 4, wave 5. Now yes, we have more than 100 to 140 bars here. So we're not trying to break this down. We're looking at a larger movement here. Let's see what's happening on the monthly chart, overall picture. So with this, the way it's played out, we have a 3, a 4, and a 5. We can see that with the divergence. Our AO crosses the zero line. And then we have an A wave, the correction, pulling back into the previous wave 4 actually went a little bit further. So this chart meets all the requirements. So remember, the 100 to 140 is to break down a wave and make sure you have all your components. You can look at more than 100 to 140 bars to see what's happening on the chart if it's clear. There's divergence there, and we have divergence here as we mentioned, so between the price of 3 and 5 and the peak of 3 and 5. Okay, next 5-wave down chart. So again, we're going to start here. We have a peak on the AO, so that's our third wave. Then we're going to look at, we have an A, 5-wave A, 1, 2, 3, 4, 5 waves of A. We have a 3-wave B and a 1, 2, 3, 4, 5 waves of wave C. And then we have 1, 2, 3, 4, 5 waves of the 5th wave coming down. So we have divergence between wave 3 and wave 5. So from this point to this point and this point to this point, the AO crossed the zero line, so everything here meets the requirements. This has the correct number of bars to see what happens in it. So we see where the AO crossed zero, ABC corrected up, 5th wave came back down. Okay, let's take a look at 5 waves on a daily chart. There's definitely more than 140 bars here, but we're taking a longer term view, and then on the next slide, the last one of this section, we'll look at a weekly chart and see what we're looking at these different 5 waves or degrees of. So starting here, we have a wave 1, and that's going to be of 3, wave 2 of 3, 3 of 3 with our peak here, 4 of 3 where we've crossed the 0 line, and 5 of 3 here at the taller price. We'll see we have divergence on the AO. Here's divergence in price compared to divergence on the peaks on the AO. This is your tallest peak at this point. Then we go down for an A wave, a B wave, and a C wave, a simple ABC correction after 5 waves. Then we're going to start up for, and here, by the way, we also cross the 0 line here, and there is no divergence between A and C, which is typical. We can have it, but typically we'll see A wave may have more momentum than the C wave, even though C is an impulse wave. Then we have a wave 1 up, a wave 2 of wave 5 down, wave 3 of 5 based on the tallest peak here on the AO, 4 of 5, and 5 of 5 here. Point out that there is divergence. Wave 3 has the tallest peak starting here. The 5th wave of the 3rd wave is lower, so there is divergence. We also have divergence between the 3rd wave, the 5th of the 3rd, and the 5th wave, larger degree 5th wave. So we have the tallest peak starting here at 3 of 3, price going up, AO going down, 5th wave, higher price here, lower peak here. So we have all the requirements met. Now to see what we're looking at 5 waves of, we'll go to the next chart. So 5 waves of what degree? That's what we're going to look at here. This is a weekly chart, so we've gone up to one significant larger time frame. We talk about if you have more than or if you don't have the 100 to 140 bars, that's only allowing you to count the wave under consideration. So let's see what we were looking at. Now, if we start here on the left, we have one of that wave 3. We started about the, I think it was right about the 8,000 area on that previous chart of counting that wave. So coming in here, 1, 2, 3 being our tallest peak, 4 of 3, and 5 of 3. An A, a B, and a C, a simple ABC correction. 1, 2, 3, 4, and looks like it could be going back into this 5th. We've already met the requirement here for the 5th wave of the 5th wave, but we're not sure if it's over yet. It, of course, could continue on. So this could be an extended wave. So as of right now, that's what we're trying to count, what we have on the screen. So here we see that the 5 waves that continued on the daily chart are just waves within waves on this larger continuation of a weekly chart of that same one. So don't worry if it's not making sense. We still have more to go throughout this presentation to help clear things up. Determine the end of a trend on the AO. After wave 4 is over and wave 5 gets underway, we can begin estimating targets for the end of wave 5 sequence. First, take the distance from the beginning of wave 1, measure the end of wave 3. Take this number and add it to the end of wave 4. Next, take 62% of this distance, that is the best target area for the end of wave 5. There will be divergence between wave 3 and wave 5 on the AO. This is an advance indicator for the end of an impulse series and a change of trend, or a correction. The price will be higher on the chart in wave 5 and the AO peak will be less than in wave 3. Again, this is kind of more of a mathematical approach to it, but I know a lot of you out there are mathematicians, enjoy that side of it. So I wanted to give you this information to be able to measure or get a target zone for the distance of the end of wave 5. Wave 4 must be complete before you can take this measurement from wave 1 and wave 4. Time for a break. We have completed the basics of waves 1 through 5. If you do not understand anything or you feel like you're a little shaky, go back, review this part of the presentation again. The next part of the presentation we're going to start with are going to be corrections. Types of corrections. We're going to take a few minutes and go into a little bit more detail about the corrections in the market. We're not trying to become Ellioticians, as we mentioned earlier. Depending on the Elliott wave theory, if you've previously studied, there are X waves, Y waves, all kinds of different explanations for what we see in the market. I still believe in the basic theories and some of the wave principles that have started. So we're going to just take a look at 3 different types of corrections, and these are the ones that we see most in the market. That's the zigzag pattern, the triangle pattern, and the irregular pattern. Zigzag corrections are the most commonly seen in the corrections. The pattern is probably the most easiest one to recognize as well. Wave A of a zigzag pattern is always 5 waves. If wave B retraces beyond 62%, then it's not usually a zigzag correction. Therefore, if 5 waves can be identified in wave A, we can expect a tradable zigzag pattern to materialize in the C wave. So what we're looking at here, this thicker line is is the A wave, and inside the thinner line are going to be our 5 waves inside of that. So if we can identify 5 waves inside of A, then what we're saying is that the C wave, the impulse wave within the correction wave, is going to be a tradable wave. Now let's take a look at a zigzag a little bit closer on a chart. So if this was the top of our third wave, and you can't see previously, but that was a third wave, so we have a 1, 2, 3, 4, and 5 waves of wave A. We have a 1, 2, and a 3 waves of B, 1, 2, 3, 4, 5 waves of wave C. So the low of wave A is not as low as wave C. We see here on the AO there is some divergence, but that's not always created. Many times there won't be divergence between wave A and wave C. In this particular case, there is. So again, we have the top of wave 3. We have a 1, 2, 3, 4, 5 of the A wave, a 1, 2, 3 B, and a 1, 2, 3, 4, 5 waves in the C wave. So this is going to be the most common pattern we see, the zigzag corrections. Here's another chart with a simple zigzag correction. Obviously this was a third wave here. You can see it going straight up. And we're looking down here at 1, 2, 3, 4, 5 waves in A, 1, 2, 3 waves in B, 1, 2, 3, 4, 5 waves in the C wave. Now I've stretched this chart out so it looks a bit exaggerated, but this is what we're looking for: the 5-wave pattern in A, a 3-wave pattern in B, and a 5-wave pattern in C. Now this wasn't a very good tradable C wave, but a lot of times you'll have a nice clean C wave that is tradable. Most important part is that if we can locate the bottom of C, we can have the best trade location to get in for the next move of the wave 5. Okay, here's our next zigzag wave 4 chart. Now in this particular one we had a third wave move down, and then we have a 1, 2, 3, 4, and 5 waves of the A wave, 1, 2, 3 waves in B, and 1, 2, 3, 4, 5 waves in C. And you can see our tallest peak here within this C wave corresponds with the third wave of the C wave. Remember, the C wave is usually the most tradable wave of the impulse waves, and here that was a tradable wave. And the best point, if we can identify C, is we know the next wave coming down, we have the best trade location to be able to get into that next trend move. Also here on the AO, we did have a little divergence again here. Sometimes we do see that happen. Typically the C wave will be taller than A, but not always. The next we're going to talk about are the flat corrections. It's very obvious to see here on the diagram if this is wave 5, or it could be a 3. A, B, and C are going to be flat, meaning that the top of the B wave is going to be very close to the third or fifth wave. So in flat corrections, each wave is almost identical or equal. In flat corrections, the B wave will sometimes have a flat ABC correction with equal legs. So not always. You can have a C wave that may go further, but typically the A, B, and C wave are going to be very similar in the pattern. Okay, now let's look at the flat correction on the chart. So we know if this is our third wave, we have an A wave, we have 1, 2, 3, 4, 5 waves in A, 1, 2, 3 waves in B, and then here's our C wave that doesn't quite go below the A wave, and we see that this is almost identical here on the top of the 3, and the A and C are very close. So this would be what a common flat correction would look like. C does not have to go below the A wave. The AO did cross below the 0 line, which is important, and then here we see 1, 2, 3 starting off the next wave sequence going up after the top of this wave 3. So a 3, a flat 4, market going up for 5. Okay, now let's take a look at irregular corrections. They're a little more unusual and a little more difficult to identify because many times we think that that B wave is actually a fifth wave. So here, this is a 5, and we have an A and a B and a C, which this B wave takes out the previous high here. Now, these smaller lines in between are other possibilities, what we call that double 3. Again, if you want to get into more detail of this particular area, we want to look at Trading Chaos First Edition. Now, in this B wave from the top, we have 1, 2, 3, 4, 5 in the C, but again, I'm sorry, B had 1, 2, 3, C has 1, 2, 3, 4, 5, but the B wave does exceed the high of the previous impulse wave. So if B wave exceeds the high of the last impulse wave, suspect an irregular correction. In the irregular correction, each leg of the AB sequence is longer than the previous leg. Okay, so here we are with the irregular correction chart. Now it's difficult to find a chart that matches identical with the diagram, but we've done pretty well so far in the presentation. So here we have a 3, a 4, and a 5. Now we have an A wave, the B wave that exceeds the high of the previous impulse wave. And remember, each leg is going to get longer. So B is longer than the A wave, and now the C wave down is longer than the B wave. So we have an A wave, a B wave, and a 1, 2, 3, 4, 5 of C. So in this particular irregular correction chart, you can see that B exceeds the previous one, and each leg of the correction is longer than the previous one. On this irregular intraday correction chart, we're going to start from the left and see we have a wave 1. And then here we have a 1, 2, 3, 4, 5 waves of A. Our B wave, which exceeds the high of the wave 1, so that's what makes us the irregular correction. And each leg gets longer. So the A wave was this distance, B wave is a little bit longer than the A wave, and the C wave is a little longer than the B wave. So each leg of this correction gets a bit longer, then off the bottom goes back up for the third wave. So after 1 we have an A, a B, and a C, B taking out the high of the wave 1, or it could be a wave 3. Triangle corrections. Now these are difficult also because these corrections come along. We think that the market may be starting back into a trend and then it heads back in the other direction. Again, we think it's starting into a trend and it heads back into the other direction. You can see that on this diagram. The triangle corrections are 5 wave patterns labeled A, B, C, D, and E. So we'll see this A, B, C, D, and E, and then the market take back off. Triangles usually occur in the next to last wave, such as wave 4 or the B wave. When triangles occur in wave 4, prices tend to shoot out in the direction of the impulse wave 3 being corrected. And when triangles occur in B wave, prices tend to shoot out in the direction of the correction wave A being corrected. Okay, now we're going to take a look at this on the chart. Again, can't get an identical pattern to the diagram, but pretty close. So here we have our peak of a wave 3. We have an A, a B, a C, a D, an E wave, and then a 1, 2, 3, 4, 5 kind of in here of the C wave. Not a clear visible count of C wave here, but this is a good picture of the triangle correction. So we have A, B, C, D, E, and then we have wave C coming down, taking out the low of wave A, and we have this whole bottom going below the 0 line. So the triangle pattern is not a typical correction after an impulse wave. The market stays range-bound within the correction phase and can last up to 70% of the time the impulse wave took to complete. So these are the most difficult corrections to trade. An increasing triangle correction. Now this here we have the bottom of a 3, so we have a starting point. A, B, C, D, E. And then we go 1, 2, 3, 4, 5 of the C wave. So here's our fourth wave with a kind of increasing pattern here as we hit the top with our C wave being the taller than the A. And then a 1, 2, and we head back down 3 for a fifth wave of some degree. So again, you'll see this pattern going back and forth, and kind of increasing before the market actually takes off for the next trend move. The AO does cross 0 again, and we didn't have a lot of squat bars present in this area, but typically we will have a lot of squat bars in the areas of these corrections. Okay, we're going to take one look at that rule of alternation that we briefly mentioned in the correction part about wave 2s and wave 4s. And this is an example. They're not identical, but what you want to see is typically we kind of see the alternation happen from one to the next. Now here we have a correction that pulls back straight down, sideways, strong correction straight down, sideways, straight down, sideways. So what you can see is typically we'll have a little sideways move, correction will go the opposite direction, sideways move. Here that correction went below 0. We have a peak of our wave 3 in here. That wave 4 crossed below 0. We then have wave 5 peak here on the AO. You see there's divergence there and between 3 and 5. And this was your pullback of that wave 4 in the wave 5. So typically rule of alternation, if we have a complex, then we're going to have a simple. We have a simple, then a complex from 2 to 4. They will alternate back and forth. It's good to know that because then you can expect, if you've seen the wave 1, 2, and 3, and you had a complex wave 2, you can expect to see a very quick and fast retracing wave 4. That's good information to know if you've got heavy positions in a wave 3. A complete 5-wave move does not usually have 100 to 140 bars in the sequence. Therefore, in order to see if the wave under consideration is complete, you will need to break the wave into the 100 to 140 bars. This could be a smaller or larger time frame depending on the number of bars in the wave that you are trying to break down. You begin counting bars from the start of the move and then adjust the number of bars on the chart to achieve the 100 to 140 to get an accurate count. High or low bar from the start of the wave is where you're going to begin. Example, if you are looking at a 60-minute chart and you only have 70 bars in the wave, change to a 30-minute chart to achieve the 140 bars. That should bring you right about to what you need. Now again, it may be anywhere from 100 to 140, it might be 95, it might be 152. It's not exact, but that 100 to 140 is important. A few bars in either direction is not going to break your count. If you can't find the right time frame, either, like I said, go up higher time frame or lower time frame to achieve the correct number of bars to break down the wave you're trying to count. If you're looking at a longer term view, again, go to the larger time frame to see what's happening in the overall trend. And this can be an infinite process as there are waves inside of waves inside of waves within waves. Meaning that if you could break a chart down to a 1 second, we could still be counting Elliott waves. So remember that we're just trying to find out where we are in the overall process and find out how that can help us in our trading in breaking down the waves. So let's look about how we break down an actual wave. So this is our starting point here where the arrow is, and this is the wave we're looking at. But what we want to see from this point is how many bars are here. We want to know if this part of the wave where we have divergence from the AO is over. There are 5 complete waves within this move here. So what we're going to have to do is go to a smaller time frame to get more bars. So we go to the next chart, which is smaller time frame, 640-minute chart, and we can see from this point here, this is where that same low was on the previous chart, and we get to see what's happening. 1, 2, 3, A, B, C of 4, going for 5. So at this time, we have 5 waves, but what we're noticing here, and what we want to point out, is the AO is still increasing. So even though this crossed the zero line and looks like our wave 4 now, it could be that this is going to continue on, make a higher AO peak, and this all turns into wave 1. This is a wave 2. But we're not sure yet. This also could turn quickly, have divergence, and create divergence between wave 3 and wave 5. So breaking down the wave can help you see what's happening. In a case like this where the AO is still increasing, you're not going to be sure if that wave is complete yet until you start to see the AO peak turn around. Now this is a 240-minute chart. This is a euro chart, currency chart. So if we're looking here from where this thick line is, we want to see from this point to here what's going on. How many waves are in here if we want to break that down? So that's roughly 2, 4, 6, 8, 10, 12, 14, 16, about 8. Okay, so we're going to break this chart down into the 45-minute chart, which is going to give us the correct number of bars starting from this point. And that's what we're looking at on the larger time frame. So when we look at these, looking here, all the way down to the bottom, we have divergence on the price, divergence on the AO between the two. We have a wave 4 that's crossing the zero line here, and we have a wave 5 coming down that's got divergence from here to here as well. So we see that we have 5 waves of some degree on this chart. Squat on the bottom, market starts to take off here. So by being able to break this chart down, we can see when there are 5 waves and might be prepared to use our indicators or signals on the time frame we're trading to get prepared to exit if we're in a position, or look for our entry signals for the next move. Now this next chart, there's 140 bars in this wave sequence. So from the start of this move to the end of this move, or where it is currently right now, there are 140 bars. So there's no need to break anything down. What you see is 5 waves of some degree. Most likely the wave 5 will be wave 3 if the AO peak continues to increase. So what I'm talking about here is that this peak could continue to increase and take out the previous peak. As of right now, this is 3 of some degree, and this is 4. But what makes me say that, and why I think this may increase, is because wave 3 should not be the shortest wave. So the way this is looking more like an impulse wave. The slope of the bars is looking steeper. As we mentioned, wave 3 is going to be steeper than a wave 5 or even a wave 1. So we'll have to see how this plays out, but that's part of counting Elliott wave. The count is going to change in front of your eyes. It's going to unfold as you're watching it. That's why it's important you have an alternative count, and also that you know what your trading system, that you have your rules and you have them in place and you don't take risks that you can't handle. Confused on the count. When you don't know where you are in the count, you're most likely in a wave 4. And that is so true. Most of the time when I look at a chart instantly and I know I'm really confused, it's a wave 4 of some degree. So be aware of an alternative count when you don't know where you are. And when you're in doubt, you can always get out of the market. If you're trading a daily chart and it does not make sense or seem to follow the rules, go to a larger time frame, a weekly or a monthly. It's going to help you understand. Or if you're trading a 15-minute chart, go to a 60 or a daily. Get the overall move of the trend. See where it's at. That is going to help you identify what's happening on that smaller time frame and what you're trading. And typically you're in a correction of a larger degree and the smaller time frame is difficult to trade. So that's really what we're saying, is that most of the time when you don't know where you are, you're just in a correction of a larger degree. And there will be times that the count doesn't make sense in real time. Grains are going to tend to be truncated and cannot follow the natural Elliott wave patterns on the longer term charts. So again, this may be the time to stay out of the market, maybe time to use tight stops or follow your system. That's why we say that the Elliott wave is not a trading system. We do not view it as a trading system at Profittunity. We look at it as an underlying structure of the market and a map to help us know when to be aggressive, when to be conservative, and when to simply just stay out of the market. So here's a daily chart, and this is kind of going to go over the confusion. So we look at this daily chart, and you can see from the left, this is Microsoft. This was a stock. Market came straight down. Market came straight up. Market goes back down. Obviously, this is a correction of some sort, correction here. But it's really not clear. If we look at the AO, we have tall peaks, peaks, peaks. We have another peak here. What are we looking at? So when I look at a chart that looks like this, the first thing I'm going to do is go up a time frame. So what I'm going to do is go up to the weekly chart. By looking at the weekly chart, that's going to give me an idea of what all that noise was, or what I call noise, on the daily chart. So here we can see the weekly chart. This is all up and down, up and down, up and down, up and down. And here is that move we saw on the daily from the top, 37, all the way down to about 15, back up here close to 31 maybe, back here to 22, back up again. But again, looking at overall, we have a tall peak here, we have a tall peak here. This market, this whole action here, when I look at this from years of experience, I know that's a correction of a larger degree. So I know instantly going to a monthly chart is going to be the answer for me to kind of get an idea of what's happening. So the first thing I see is this large, huge peak on the AO, which is a wave 3. Probably will turn into a wave 1, looking at what's happening, but now it's a wave 3, meaning that this entire move here is a wave 4, a long correction. This correction started back in 2000, so we have seen 11 years of a corrective move. It has retraced about 50% of the wave 1 or the wave 3 that we have coming up here, and the entire move we've been seeing on the weekly and the daily chart has all been a larger degree correction, so it can explain that type of behavior. There's no way to know how long it will last. If I look at it visually, it looks like this move should be pretty close to being done, and we could be done now. This could be the beginning of the next wave up, a 1, a 2, and a possibly heading back up again. Only time will tell how that's going to play out. If that's true, then I have just given you something to look at for the future. Let's talk about magic bullets that can kill any trend. I've referred to our first book, Trading Chaos, and that's the first edition. It talks about the magic bullets, and these are things that we call these components that once they're there in a chart in the market, they have the ability to kill a trend. Doesn't mean that once they're there, the trend is over, but it just means that these components being there, it has the information, or it has the pieces that it needs to be over. So the first one's the change in momentum, a fractal in the opposite direction, a squat bar, one of the top or bottom 3 bars, divergence on the AO and the price chart, and the target zone or retracement area for your 5th or 3rd wave. So when these components are all present in the market, many times we'll see a market change very quickly. Let's do a quick review of the Wave A. Wave A, corrections are typically harder to identify than impulse moves. In Wave A of a bear market, the fundamental news is usually still positive. Most analysts see the drop as a correction in a still active bull market. Usually the AO crosses the 0 line in the A wave. Wave A can have 3 or 5 waves, but usually have 5. A 5-wave A indicates a zigzag correction pattern. Okay, let's review the B wave. B wave prices reverse higher, which many view as a continuation of the now disappearing bull market. Those familiar with classical technical analysis may see the peak as the right shoulder of a head and shoulders reverse pattern. The volume during Wave B should be lower than in Wave A. There are usually a lot of squats present in the B wave, and no one is really in control. There are also usually 3 waves in the B wave. Review of C wave. Wave C, prices move impulsively lower in 5 waves. Volume picks up, and by the third leg of Wave C is typically at least as large as Wave A and often extends to 1 to 1.618 times Wave A or beyond. There should be no divergence between A and C on the AO, but sometimes there will be, as we've shown you in this presentation. And the C wave has the same characteristics of an impulse wave, 5 waves. It is a tradable wave. Okay, let's review the correction types. Wave A of a zigzag pattern will always have 5 waves. Wave B will always have 3 waves. And Wave C will always have 5 waves. In flat corrections, each leg will have an almost equal or identical parts. Sometimes the B wave will have a flat ABC with equal legs. In irregular corrections, the B wave exceeds the last impulse wave, high or low, and expect each leg of the ABC sequence to be longer than the previous one. Okay, let's do a quick review of all the information we've covered up to this point so far. Movements in the direction of the main trend of the market occur in 5-wave impulse waves, while corrective waves are always 3-wave affairs that follow. Wave 2 cannot retrace more than 100% of Wave 1. If that happens, the impulse of interpretation was incorrect, except in commodities, as we have shown you and we have mentioned in this presentation. There are exceptions. Wave 3 is never the shortest wave in terms of price. It does not have to be the longest, but in such a case, either Wave 1 or Wave 5 must be shorter. Typically, the length of Wave 1 and Wave 5 added together gives you about the length of Wave 3. That is what we usually see. Wave 4 cannot overlap Wave 1, usually ends in the area of the previous Wave 4 of a smaller degree. So as we've shown you many times here, that the big Wave 4 is going to pull back and end close to about 50 to 62% of the time in the area of the larger or lesser degree Wave 4. And we also have the rule of alternation. So if you have a simple Wave 2, meaning you have a quick ABC, then your Wave 4 is going to be complex. If your Wave 2 is complex, then your Wave 4 is going to be simple. This is very standard. I don't see many exceptions to this rule happen. This is something that you can pretty much count on in the correction of Wave 2s and 4s. Wave 5 is the final leg in the direction of the dominant trend or the impulse move. Volume is often lower in 5 than it was in 3, and there will be a divergence on the AO between Wave 3 and Wave 5. Wave 1s can look like a Wave 3 on the AO until they develop. So Wave 1 is going to look like your taller peak. Wave 3 is going to come in and take out that peak. There'll be a divergence within Wave 3 between Wave 3 of 3 and 5 of 3. Your AO will then cross 0, and then you'll have a Wave 5, and the peak of Wave 5 will be lower than the peak of Wave 3, which creates divergence, and your price, of course, will be the tallest on Wave 5. You're going to have squat bars present. You'll be looking for all of the things that we have discussed so far and applying them on the chart in our next section. If you have any questions, you're not feeling completely confident, please go back, review any of this material, reference our first book, Trading Chaos First Edition, our second book, and of course there's also references from R. Elliott all over the web. Okay, it's time for you to take a break, maybe do some review, and get ready for the last section of this course. Okay, we're going to do our final review now of charts. We're going to take all the information that we've had so far, and we're going to put it on the charts and see that hopefully we'll put it together and that everything will start to make sense for you and you'll be able to ride the waves like you see here in this picture. First one is going to be a U.S. Euro Forex chart. As we've mentioned before, this method works on any chart, any time frame, from stocks, commodities, Forex, ETFs, intraday, position, weekly, monthly, daily, it doesn't matter. We're still looking at the underlying structure of the market. So starting here, we have a Wave 1, a Wave 2, and a Wave 3 based on the peak at this point. We see that was a Wave 4 of some degree, crossing 0 within that impulse wave. We have an A and a B and a C corrective wave that pulls back a little bit further than the previous area of correction. Now, I do have noticed here there is no squat bars in the Forex chart due to the way volume is or isn't reported. So if you're trading Forex, you're not going to have squat bars present on your chart. Okay, let's look at our second Forex chart. We're going to start here on the left with our wave 1. That was the top of wave 1. You can't see it because I had to cut it off, but we need the right number of bars to be able to view this wave. So that was wave 1, wave 2. This is wave 3. Now notice wave 2 retraced very quickly. I would call that a simple wave 2. So we can expect our wave 4 to be longer in time than in price. We go here to the peak on our wave 3 on the AO, so we know this is our wave 3. We have wave 4 of 3 where we cross the 0 line, and wave 5 of 3 up at the top. We have a little divergence here, not much. The 5 of 3 went just a little higher than the 3 of 3. Then we have an A, a B, and a C wave of the wave 4. Also, that wave 4 did cross the 0 line in the big one, as well as here, because between here and here there are 140 bars. So we saw wave 4 cross 0 within this move. Now I know there's no squat bars here. Squat bars, as we said in the last one, do not show up on the Forex chart, so you don't have those little extra bits of help to get you seeing where the end of the trend is going to be or where a turnaround might be. But you still can count the Elliott wave. You can still see the AO perfectly, the peaks, and of course the fractals and the price bars. Now here's an S&P monthly chart. Now here we're going to talk to you. I have two possibilities, and we talk about having an alternate count. This is my first count. If we have a wave 1 and a wave 2, a wave 3, here's our tallest peak with this big blue arrow indicating wave 3, A, B, and C. Now if that's true, it would be an irregular correction because of where B came to. So that is one possible count here with a wave 1, 2, starting heading up the next direction, with wave 5 would be taking out the previous high of this wave 3. And we see that wave 4 crosses the 0 line here also. Now that is one count. We know there's more than 100 to 140 bars here. We're not trying to break them down. We're trying to see the overall big picture. Our tallest peak there on the upside is wave 3. Our alternative count, which I always like to have, which should be a wave 1, a wave 2. We still have the peak of wave 3. That does not change. This may be the large degree wave 4, wave 5, an A, a B, and that means the market would head back down for the C wave, which would have to go lower than A, which is kind of a pretty scary thought economically. So I'm not sure which count is correct. That's one of the things about Elliott wave. It's why I don't trade strictly Elliott wave. I'm always ready to look at the alternative count. So the possibility, the alternative here is that this is a 1, 2, 3, 4, 5, A, B, and a C wave to finish this particular larger degree move. So only time will tell. Again, no doom and gloom here. We can make money no matter what way the market goes, up or down. We just want to make sure we follow our trading signals, and again, have an alternative in case you're wrong with your first count, which of course the first count is the one we'd like to most agree with. Gold on a weekly chart. Taking a look at gold, we have seen some amazing things happening in gold over the last several years. Gold was in a sideways market for over 20 years, or in a correction for over 20 years, which we will talk about. But the potential for gold, what we see right now, is great. Right here we have a 1, a wave 2, and a wave 3. Now, at this particular time, that wave 1 peak looked like it was our wave 3, and it was also pretty steep price. Wave 2 pulled back, went below the 0 line here, and then we find out that this particular peak, where the blue arrow is pointing to, is taller than the previous peak. So this indicates that this is wave 3 of some degree. So with that being said, what happens is waves will unfold in front of your eyes. Wave 1 looked like wave 3. Now wave 3 turned into wave 1. Wave 3 is still developing, and it can continue and go forth. So we have to be flexible with our count and be willing to follow the signals. So what I have here is potential to see gold go to highs of over $2,000 per ounce. If it's following this count and what we're seeing here, we are going to see gold hit over $2,000 per ounce in the next year or 2 years, possibly sooner. We don't know how fast this will happen. Now this chart's going to look a little bit different. I'm introducing a third visual indicator here, and that is our alligator. It's a smooth moving average, so that we use in the profitability method. Within seconds you can look at a chart and know where you are. For a lot of you that are familiar with our methods, have read any of our books, you do know what the alligator is. So I've added it here at the end, and you can see when the alligator's wide open, we're in a trending market. When the alligator starts to twist and turn, we're in a correction, and this is that same gold chart monthly. So we had a peak of wave 1 here, and we've had 20 years of sideways action of a complex wave 2. So with this wave 2 looking like this, after this wave 3 is over, we'll probably have a very quick wave 4 that could pull back very fast, far in price, and then head back up for wave 5. So as we see here on the AO is still increasing. So the third wave on this monthly chart on this large degree of gold is not over. Alligator is also telling us it is wide open here, running parallel with these price bars. Next is simple similar corrections. We talked about that. A lot of times we'll talk about like a correction being a cousin or a relative. Well, if we see the pattern here, this little simple ABC, and we see the pattern here of ABC, they look alike. If you were to shrink this larger one down, it looks very similar to the previous one. So part of that fractal self-similar repeating patterns. We see that quite often in the market, and we also see here that the low of this correction retraces almost to the same area of the previous low of that correction. So these are all things hopefully by now you're starting to see or get some pattern recognition in the market. Alligator's wide open here, impulse moves open, sideways or flat in corrections open, and then of course the C wave is an impulse wave within the correction, so the alligator is going to be open during those times. Okay, let's take a look at the dollar index on a monthly chart. Here we're going to start on the left of the chart with a 1, 2, 3, 4, 5 of wave 1, because we know if this is our tallest peak over here that this can't be. So if that's a 3 coming down, we just go backwards. 1, 2, 3, 4, 5 waves of the first wave, an A, a B, and a C of wave 2. 1, 2, 3, 4, 5 waves of the third wave, and we see we have divergence here from the peak 3 to the 5 of 3 from here, and of course wave 3 is taller than wave 1. Next we have our wave, large degree wave 4, where the market went right into the mouth and through the alligator, bouncing back and forth. So it looks like we have an A wave and a B wave going on here currently. But what I most want you to see is that recognize if this is 1, this is 2, it retraced 62%, it was very quick, then we could probably see this wave 4 go sideways for a bit of time. And it could go up to 70% of the amount of time it took for this wave 3 to complete the development. So one of the things we want to know is that we're not trying to become Ellioticians. We're not trying to break down. I mean, we could get in here and break 1, 2, 3, 4, 5 and try to go A, B, C and count every wave inside of the wave. Then we become Ellioticians. What we want to do is get the basic underlying structure and the rules of the Elliott wave and be able to apply them with our signals in the market and be more profitable. Okay, here's our mini silver chart on the daily. And we're starting to see here a pattern. Here's the alligator that's intertwined. Then we have a market that breaks out. What we think is a third wave here. We're looking at that peak. Market continues up, pulls back. It turns out to be a wave 2 because we see here wave 3 is the tallest peak on the AO. So this is where we're talking about. We have that wave, what we think is a wave 3 turns into being a wave 1, even though there's divergence here. Wave 2 crosses the 0. And now we have a current wave 3 that's still in process. We see the alligators also wide open. So hopefully this pattern, you're going to keep seeing it over and over again. We see a correction, and then we see a pullback, and we see a trend move. We see a trend move, and then we'll see a correction following in the other direction. So this is the pattern that we're going to see over and over again. This is an E-mini chart. Doesn't matter what time frame, what market you're trading, you're going to see that the Elliott wave is the underlying structure of the markets. So I want to take a little bit longer view of the monthly chart on silver. We just saw the daily chart and we know that we're still in a third wave. But let's take a real diagram kind of here of looking. If we look back here, this was back in 1980, silver hit a little over $50 an ounce, and then the market pulled back very quickly and went into this long correction. Now two things happened. Yes, it pulled back very fast, but then it also went long sideways. So I consider this a complex correction. Continued on, and then now we see that the AO is increasing. Now the AO is not as tall as the first peak, so this, historically would have been wave 3, even though we don't have much data behind it. We go through, market did go into the correction and went below the 0 line. The AO comes up, it increases, and again, it is still increasing. Now, alligator's wide open here. What we're looking at is I have a projection up here. It has to go above this, but I don't have enough room on the chart to show you everything. If this pattern or this chart follows typical Elliott wave patterns, we could see silver hit easily over $100 an ounce in the next 5 years. I don't know, again, when, like in gold, we don't know when we're going to see these things happen. But typically following the patterns and looking what's happening with the dollar and the economic situation that we have going on and the deflation of the dollar and inflation, this gold and silver and these precious metals seem to be markets that we're going to continue to see uprising. And according to the Elliott wave, which is a natural phenomenon, somehow these follow right in with those patterns. So we're going to see silver take out and have some extreme highs by the time the fifth wave is complete here. Okay, let's look at the soybeans on the Globex daily chart here. Now this wave has 145 bars in it. Sometimes a wave can have 99 or 145 or even 150 maybe. It is an accurate count of the wave under consideration as long as you're close. We're not doing an exact science here. We're just trying to get the basic principles. So we have a wave 1, wave 2, wave 3. We find our peak here on the AO, so we know that's 3 of 3, 4 of 3, and 5 of 3. We have the arrow here, so circling the wave 4 of the 3. We also notice here on the far right the A wave of the big wave 4, the larger degree wave 4 that follows the third wave, and it also crossed the 0 line. Along the way we have squat bars at the measuring squats. We have bottom bars, trend ending, trend ending. So what you're going to notice in the grains many times is squat bars will be present quite a bit right before a change in trend. So when you put all these together, you've got the AO, you've got divergence, you've got a fractal, change in momentum, and a squat bar, and you put your indicators on top of that, it's going to give you very good placement for knowing where the next move or to expect the next trend to be. Now let's look at the Australian dollar on a daily chart. If we start from here, we're going to see we have a wave 1 up, small wave 2, wave 3 of 3, 4 of 3, 5 of 3. Again, this has about 140 bars in the wave. So you will see it cross the 0 line on the time frame that you're looking at. You have divergence here from wave 5, 3 of 3 here to wave 5 of 3. The AO peak here, you can see a wave 1 looked like it was the tallest at that point. And we just finished a correction here. So 1, 2, 3, 4, 5 of 3. Alligator closes, intertwines, market goes into a larger degree fourth wave. Hopefully you're starting to see this pattern, have a little pattern recognition. We're looking at 5 waves corrected by 3 waves, 5 waves corrected by 3 waves, and we get to a large degree or a point 0 when all 5 waves of the daily, the monthly, and the weekly have completed a 5-wave move. Then we're going to see a move in the opposite direction. So we're going to combine these different time frames to see where the overall trend is. You may be making money on a weekly position as you're long, and you could be going short often intraday. So we mentioned that in the tide, waves, and ripples of the market. Depending on what market time frame you're trading, you have different opportunities to make money. Okay, now this is the soybean oil on the daily chart. It looks very similar to the soybeans, but it's a little bit less volatile. We're going to start here on the left. We have a wave 1 of 3, 2 of 3, 3 of 3, 4 of 3, 5 of 3. Again, from this point here to this point, we have about 140 bars, so we're going to see that wave 4 cross 0. It barely crossed, but the wave 4 within the wave 3 did cross here on this time frame. There's divergence from 3 of 3 to 5 of 3, and the large degree wave 4 did cross the 0 line. So we have an A, a B, and a C wave with a squat bar on the bottom, and the C wave here did have a taller peak on the AO. You'll notice again a lot of squat bars in this, and typically the grains will turn on a squat bar ending. So hopefully you're putting this all together and it's starting to seem like you understand a little Elliott wave by now. Here on the Apple stock chart, this is a monthly chart, and we're going to take a look at the overall pattern what we have here. Starting on the left, again, we see the alligators intertwined and closed. We have a trend move that starts an impulsive move up, pulls back, and creates a correction here, a wave 2, and a wave 3 in process. Now we're looking at the AO. We know because the tallest peak is here that this is our wave 3 of some degree. We know this has to be wave 2, and this would be wave 1, being able to count backwards. So being that this is a monthly chart, what this is telling us is that there's a lot of room for Apple to go here. Currently, at the time of this presentation, it was trading at about $356 a share, almost $357. So what we're going to look at on the next chart is breaking this down into a weekly chart and seeing what we're looking at from this point to this point and see how far along we are in the wave. Now if we look at that same Apple chart on a weekly, or Apple stock on a weekly chart, excuse me, we're going to see from where that move began. That's where that move began on the monthly chart. And this is that move on the daily chart. Now in the beginning we saw we had a peak and we had divergence from here to here and here to here. Then we had a new taller peak created, so the divergence went from here to here, creating a single divergence, and then yet another. So the price is here. So we have a double divergence from here to here, but then now all of a sudden we have a new taller peak coming out, takes out our previous one, and tells us that we're still in or creating the third of this wave. So this stock is not near finishing the third wave. It still has a bit of wave to go at this time. The wave 3 is not complete on the AO and still increasing. The wave has 103 bars from the bottom of this wave. It's not crossed the zero line, so we are still in wave 3 or developing wave 3 of some degree. Hopefully this is starting to make sense to you by now. Okay, so here we are on the euro currency, and this is the monthly chart. There are just about 100 bars or just over 100 bars in this wave so far. Now what we want to do is take a look at the overall picture and then get an alternative count as well as what we have here on the chart. So starting here on the left, we have a wave 1, a wave 2, and a wave 3 of 3, an A, a B, and a C of 4 of the wave 3. Now alternatively, this could be a longer degree B wave. This may not be the C wave here, the bottom of. We could see this intertwined for quite a while with the alligator. That's one of the reasons why we don't trade simply Elliott wave. We trade the markets and we trade our signals, but having that information behind us will help us get good trade location. So on this particular chart we can see the wave 1 of 3, wave 2 of 3 pulls back, wave 3 of 3 is our tallest peak. We have an A, a B, and possibly a C wave, or possibly an A, and we're going to have a longer term or an irregular complex correction that's going to happen here in the 4 of the third wave. So we'll have to wait and see what happens. That's the only thing we can do, is to see how it plays out. But I always like to have that alternative count. If that's not the C wave, the market may not continue up, may come back down again and create another C wave. Let's take a look at this crude light on the monthly chart. Now if we notice here, starting on the left, we have a little wave 1 up, we have a long wave 2, and a long wave 3. Looking at the peak on the AO, this monthly chart, this high up here, which is a little bit over about 142, 143 a barrel when it hit those highs back in 2008. That is our wave 3. Now if we look backwards, knowing the information we know so far, this wave 2 was long and complex. So what happened with our wave 4? It was very fast, quick and simple. It retraced very fast in time and price. Now it looks like we're going into the wave 5 up again. So we have the AO cross zero here in the 4. There's more than 150 bars here, but in this particular wave, just from here, we have enough bars we can see what's happening. This is a long-term view of crude, though. So if this is wave 1, we had a long, complex wave 2. We have a wave 3 up, a wave 4 that retraced more than 62%, a little bit more than that, and it looks like we're going into a wave 5. Alligators open, of course, at this point. So this is what we're looking for on these charts. This long-term view can kind of give us an idea of what's going to be happening on the smaller term. Now here's 5 waves on the stock chart, another stock chart. We looked at some previously. Here we've got the wave 1, wave 2, our wave 3 of 3, wave 4, and wave 5. We have divergence between wave 3 and 5 of 3. The AO crossed the zero line in 4. We have about from here 20, 40, 60, 80, 100, 20, 40. We have about 100 and not quite 140 bars from this point to this point. So that's why we're saying this is the wave 4 inside of the wave 3. Now you're starting to probably see that a lot and be able to tell the difference, because many times when we're counting a wave, if there's the correct number of bars, it's the wave 4 inside the wave 3. If we mistake that, then we think we're in a large degree wave 4, and you'll be surprised when the market heads back down to complete the 5th of the third wave, either up or down depending on what type of market you're looking at. So make sure that you have a good understanding of 1 through 5. After we have 5, then we're going to have this correction go in the other direction, and you see the alligator turns together. We also have squat bars located at almost every turn or change of point in this market. So the fractals, the squat bars, the AO, divergence, crossing of zero, all of these factors are things we're putting together to visually be able to see how to count the Elliott wave. Now the next is going to be our final chart, and we're going to take a look at 5 waves unfold on an intraday chart. Okay, let's take a look at our final chart. This is going to be a 5-minute E-mini Dow chart where you can see a 5-minute or a 5-wave move unfold right in front of your eyes. So we're going to start here on the left with a wave 1, wave 2, wave 3, wave 4, and wave 5 of wave 3. Now there's not enough bars in this wave to see the wave 4 cross the 0 line in the area where the arrow is pointing to, but if we broke it down you would. But the wave 4 of the larger degree here we do see cross the 0 line as we've circled below on the AO. So 5 of 3, A, B, C of the large degree wave 4 and wave 5 here. Wave 5 takes out the price peak of wave 3 but doesn't take out the peak of the AO. So we have divergence there between wave 3 and wave 5. So if we see here the wave unfold in front of your eyes, all of the components are here. Whether you're looking at a 5-minute, a 15, a 30, a 60, a daily, a weekly, a monthly chart, the Elliott wave is the same as it unfolds. It's the same patterns of 5 waves corrected by 3 waves. So hopefully at this point through this presentation you've got a good idea looking at charts. You're feeling more comfortable and you'll be able to put some of this into practice. We're going to go into a few more things before we end this presentation. Okay, let's do one quick final test review chart and see if you can recognize the waves. I'm going to give you a moment and not say anything, and then slowly one by one we'll bring each wave out for you to count it. So remember, find your peaks, and I did give you a little hint here with the line over the divergence. Okay, so does that help hopefully by now? Now here's our tallest peak of wave 3, even though it's kind of difficult to tell. So now from here forward it should be very easy for you to see where you are. If that's 3 of 3, the next low is going to be 4 of 3, and then our next high will be 5 of 3. I hope everybody's with me. Now you have seen this chart before, so that is a clue. You have an A wave, we have a B, and we have a C wave of a wave 4 correction. Then we move up for wave 1 of 5, 2 of 5, 3 of 5, 4 of 5, and we finally have 5 of 5. So hopefully, even though we have more than 140 bars here, I wanted to take a longer look at this. Again, we've seen this earlier in the presentation, so I just wanted to give you a little test. Hopefully everything's put together. If not, go back and review, and we'll move on to the next slide. And finally, I'm going to give you my 10 rules for success. Use a proven trading system. No matter what system you're using, if it's the Profittunity or one you already have, make sure it's a proven system and that you feel comfortable with it. Next, the other most important part about that system is follow the rules of your system. I can't tell you how many traders will call me and I'll say, well, what happened? What's going on? And they'll go, oh, I didn't follow the rules. So if you have a good system, then use it and follow your rules. Be aware of the overall trend. Always remember as a trader, the trend is your friend. This is where the most money is made in the market. The significant amount of money comes out of these third waves and fifth waves. So hopefully with the information you've learned in this presentation, you'll be able to identify 1 and 2 and be able to trade that 3 and 5. The next one is cut your losses quickly and stay in with your wins. Huge problem for traders. They want to stay in with a loss, hoping the market's going to come back. That's not how to trade profitably. Cut your losses, get out. There are losses in the market. There's no way that we can trade without having losses. That is part of trading. But if you can manage your losses and your wins properly, you will see a huge increase in your trading results. The other is never margin over 75% of your account. If everything were to fall out or the bottom falls out and every stop gets hit, if you've only margined 75% of your account, you'll still have 25% to come back in and trade with. The next is understand systems win-loss ratio. Very important for traders. If you don't understand how the system works and that your system may have 5 losses before you have 2 wins and you give up on number 4, you're not giving your system a fair chance. So have a good understanding of the system's win-loss ratio, and do that even with paper trading if that's what you need to do to get an understanding if it doesn't state that clearly. Next is don't overtrade. How many traders overtrade? It's a huge problem because we think as a trader we must be in the market all the time. That's not necessarily true. As a good trader, we want to be in the market at the right time. And when in doubt, get out. When you don't know where you are, your intuition, all your bells and whistles are going off, things aren't going your way, you can just get out of the market. That's one of the beauties of the market. It's not like a job where you have to ask somebody to get out. I can just exit all my positions, get flat, reassess, and get back in when the time is ready. The next is manage your fear. Do not let it manage you. You know, fear is part of trading. Fear is part of our natural intuition. But it's important that we manage our fear and that we don't let it take over and manage our trades. And finally, be patient. Wait for the signals. One of the beauties about the market is that it's there every day. It doesn't know when you've been there or when you've left. So be patient. Wait for the signals to show up. Hopefully with the information you've learned in this presentation or this course, you'll be able to add that with your signals and have a much more profitable trading. And one thing I want you to remember, if you can't afford to lose, you can't afford to win in the markets. And some final thoughts. I don't trade the markets based strictly on Elliott wave counts. I use it to complement the profit-only trading system, and the reason being is that there's no way to know if you're accurate in your count until it's hindsight. The most difficult part of the Elliott wave for most traders is to know when to be flexible and when to let go of their ego and just follow the market. The market is not your problem. Your problem is that you see the market as your problem. And if you're not enjoying trading, maybe you're not doing it right. This presentation is dedicated to my father, Bill Williams. He gave me the opportunity to learn everything I know about the markets and the Elliott wave. My father's research has made it possible for me to understand a complicated subject like Elliott wave without being a mathematician. His dedication to traders has been an inspiration to me, and it makes me proud to be able to continue to teach his method to traders around the world today. My dad is turning 79 this year, and he's still trading every day. These 5 simple words are what have kept him successful, and that's want what the market wants. I also want to thank my mother and my husband for their support. Without it, I wouldn't be able to do what I do today, and that's teach others. If you want to learn more about us, you can go to our Profituni Trading Group website, www.profituni.com, and may all that you wish for be the least that you receive. Good trading. These examples in this presentation are for learning purposes. All charts are real, and there is a loss of risk in trading. We do suggest that you have education before you put real money into the markets. References that were used during this presentation: Trading Chaos First Edition, New Trading Dimensions, Trading Chaos Second Edition, the Mandelbrot Fractal Geometry, Elliott Wave Principle, Market Movement Theory, of course Wikipedia for different references off the internet, and commodity quote graphics for using their charting and their indicators.